I told you. 1 hour before the drop, I said it clearly. Silver could fall further. The paper price was sitting between $82 and $83. Then it happened. A brutal 10% crash in 90 minutes. $3.6 trillion evaporated from global markets while you were scrolling through your phone. This wasn't a correction. This wasn't profit-taking. This was coordinated financial warfare. And if you didn't see it coming, you weren't paying attention to the pattern that has destroyed every empire in recorded history. Let me be absolutely clear before we go further. I will never ask you for money. No courses. No signals. No private groups. No mentorships. If someone is using my name or my content to sell you anything, report them immediately because it's a scam. What I'm giving you here is pattern recognition education, not financial advice. I'm not building a sales funnel. I'm building a record of what happens when monetary systems reach their mathematical breaking point. If you're learning something, if you're cross-checking the data I'm showing you against public sources, and it's sharpening your understanding of how these markets actually operate, leave a comment. Just say you're paying attention. That's all. 2 words. It tells me who's doing the work. Protect your capital. Verify everything I tell you. Stay away from anyone promising easy returns. Because what's coming isn't about returns. It's about survival. Current prices as I'm recording this. Silver Western Spot is $75. Futures trading at $76. Shanghai Spot is $82. Shanghai Futures are $85. That's a $7 premium right now. Gold Western Spot is $49.34. You can verify every single number I just gave you on public exchange data that updates in real time. $3.6 trillion vanished in 90 minutes. Gold dropped 3.76%, which erased nearly $1.34 trillion from its market capitalization. Silver dumped 8.5%, wiping out $400 billion. The S&P 500 fell 1%, erasing $620 billion. Nasdaq crashed more than 1.6%, wiping $600 billion. Crypto dumped 3%, $70 billion gone. This wasn't random volatility. This was a deliberate takedown, and it happened exactly when the technical structure said it would. In my last video, I walked through the 150 exponential moving average on the hourly chart. I explained it was acting as resistance, not support. When price sits below that level, it means the structure is vulnerable to further decline. That's not prediction. That's reading what the chart is telling you about where the pressure is building. And that's exactly what played out. The people who actually watched that video and understood what resistance means, they weren't blindsided. They saw the setup. They managed their risk accordingly. They're still in the game. Here's what triggered the cascade. SLV, the major silver ETF, is now trading at a heavy discount to its net asset value. When that happens, banks can exploit an arbitrage mechanism. They buy the cheap ETF shares, redeem them for physical silver, and use that physical metal to cover naked short positions in the futures market. This is sophisticated market manipulation using the structural mechanics of ETFs to suppress paper prices while simultaneously removing physical supply from circulation. When SLV trades below net asset value, authorized participants can purchase shares at a discount, redeem them for the underlying physical metal, and deliver that metal against short contracts. That's the mechanism. You can check SLV premium and discount data yourself. It's tracked daily. It's publicly available. It's verifiable. Then there's the timing. The Shanghai Metals Exchange closes this Sunday, February 15th, and doesn't reopen until Monday, February 23rd. 8 full days where the Eastern physical market goes completely dark. I've been warning about this for 2 videos now. Expect aggressive manipulation in the fraudulent Western paper markets during this window because the banks know the Shanghai bid disappears. They know Eastern buyers can't absorb the selling pressure. They're using that vacuum to push prices down without resistance. This is textbook timing. If you verify the historical patterns during past Shanghai closures, you'll see this playbook has been run before. Same pattern, same sequence, same outcome. But here's what nobody is connecting. Tomorrow is CPI day. The Consumer Price Index data drops. Did someone get early access to the actual numbers? Is that why $3.6 trillion evaporated today, the day before a major economic data release? When that much capital vanishes in 90 minutes right before critical inflation data goes public, that's not coincidence. That's positioning. That's front-running. The establishment has tools most people don't even know exist. Early data access, coordinated algorithmic selling, spoofing mechanisms that trigger stop losses and create cascading liquidations that look like organic market moves but aren't. This is financial warfare. Legendary silver analyst James Turk just issued a warning. He said a silver squeeze is possible in March, when someone with his track record, someone who has been analyzing precious metals markets for decades, makes a specific call with a specific timeline. The people who do their homework listen. March open interest still sits at roughly 65,000 contracts. That represents 325 million ounces of paper claims. Meanwhile, COMEX registered silver, the physical metal actually available for delivery, sits below 100 million ounces. February 27th is the first notice day for March contracts. If delivery intentions stay anywhere near February levels, when over 100% of open interest demanded physical metal, March faces a historic stress test. Mathematical certainty. Here's the technical breakdown for anyone trading the short-term volatility. Silver crashed to $75. If 74 holds as support, we have the potential for an inverse head and shoulders pattern developing on the charts. That's a bullish reversal setup if it confirms with volume and follow-through. But if 74 fails to hold, we could retest the lows near $64 from the previous crash. This is tape reading. This is identifying the levels that matter so you can make informed decisions about your own risk. That said, we need to see a base form first. We need to see proper price displacement and accumulation to validate any bullish thesis. You don't catch falling knives. You wait for confluence. You wait for confirmation. You manage risk first, opportunity second. The 150 exponential moving average on the hourly chart that I discussed in the last video is still acting as resistance. Price hasn't reclaimed it with any conviction. Every attempt to break above gets rejected with selling pressure. That tells you the paper market structure remains vulnerable to further downside. As long as that technical resistance level holds, additional selling is structurally possible. This is why I emphasize capital preservation over chasing price moves. The traders who protected their capital during this volatility are still solvent. They're still in position. The ones who ignored risk management are underwater or stopped out completely. Meanwhile, the Shanghai premium expanded to $7 from $6. Physical silver in the East is still commanding a massive premium over the paper price in the West. That divergence is widening even as Western paper contracts get smashed lower. Think about what that means. Real buyers demanding real metal are paying significantly more. Paper traders selling synthetic exposure are pushing the price down. When those two realities exist simultaneously, the paper pricing mechanism is fracturing in real time. This is the signal. Physical is separating from paper. People are saying gold is crashing. Gold is up over 50% in the last 6 months. When they tell you precious metals crashed, tell them to zoom out. When in doubt, zoom out. This is volatility within a structural bull market, not the end of the trend. The people who understand market cycles versus short-term noise aren't panicking right now. They're reading the tape. They're managing their risk. They're waiting for confirmed technical setups with favorable risk-reward profiles. The volatility is not going away. I've been saying this for multiple videos. Silver can move 8% in 90 minutes in either direction. That kind of price action shakes out weak hands. It triggers stop losses. It forces liquidations. It's designed to create chaos and capitulation. But underneath the volatility, the fundamental setup hasn't changed at all. 6th consecutive year of supply deficit. India is importing 25% of global mine supply. COMEX registered inventory is below 100 million ounces with March open interest representing 325 million ounces of claims. China was in record backwardation before the holiday even started, paying deferral fees to avoid taking delivery because they couldn't source enough physical metal. These are facts. These are verifiable data points. Not opinion. Pattern recognition. Let me address what might happen during the Chinese New Year closure. This price slam could be the prequel to more manipulation next week while Shanghai is dark and unable to provide a physical bid. Or it might have knocked silver down hard enough that it stays unconscious for the entire 8-day period. The chances of a quick recovery seem remote given how violently the takedown was executed. The banks are attacking right on schedule, exactly as I outlined in previous videos. The timing isn't coincidence. The mechanics aren't random. This is financial warfare using technical vulnerabilities and calendar-based windows for maximum effect. Same pattern, same sequence. Same outcome. Here's what you need to understand about what I'm doing. If you're not following me on X, the link is in the description. I share charts, data, and market structure analysis. No hype, no price predictions. I'm reading the tape, identifying key technical levels, and documenting historical patterns during Shanghai closures and delivery periods. That's education. That's showing you how to interpret the signals the market gives when you know what to look for. Tomorrow the CPI drops. Watch how markets react. If inflation comes in hot and metals rally, that confirms the pre-positioning theory. They smashed prices down to accumulate before bullish data went public. If CPI comes in cool and metals drop further, that confirms the deflationary scare narrative they're pushing. Either way, the price action tomorrow tells you what the smart money already knew today. You can't unsee it. Let me give you the bearish case, because risk management requires considering what can go wrong. This crash could extend lower. The $74 support level might not hold. We could retest 64. The Shanghai closure creates an 8-day vacuum of physical buying that enabled this smash in the first place. March contract holders can roll their positions to May, avoiding delivery pressure entirely. Tomorrow's CPI could trigger more volatility in either direction depending on the print. Paper markets have manipulated precious metals for decades despite recurring fundamental tightness, so there's no guarantee the manipulation ends on any specific timeline. The 150 exponential moving average resistance is confirmed. The technical structure is vulnerable. The banks are attacking right on schedule, which means they have a playbook and they're executing it with precision. The SLV discount arbitrage mechanism means they have a tool to extract physical metal while simultaneously suppressing the paper price. Sophisticated spoofing without corresponding volume means they have algorithms that trigger cascading stop losses that look like organic selling but aren't. This is why capital preservation matters. This is why I emphasize using your own brain and doing your own research over blindly following anyone, including me. But here's what the actual data shows when you verify it independently. The Shanghai premium is $7 and widening even as the paper price crashes. That's physical separating from paper in real time. James Turk is warning that a March squeeze is possible based on delivery mechanics that are building structural pressure in the system. COMEX registered inventory is below 100 million ounces with 325 million ounces of March claims outstanding. That's a coverage ratio that's worse than February, and February saw over 100% of open interest stand for delivery. The Silver Institute confirmed the sixth consecutive year of supply deficit. India's structural demand represents 25% of global mine supply. Texas is minting state coins for retirement accounts, creating a new institutional bid that didn't exist before. The fundamentals didn't change in 90 minutes. $3.6 trillion of market capitalization wiped doesn't alter the fact that for the sixth straight year, global demand exceeds supply by 67 million ounces. It doesn't change the fact that China was in record backwardation before the holiday, paying fees to defer delivery because they couldn't source enough metal. It doesn't change the fact that February deliveries exceeded 100% of open interest, and March is facing the same setup with a worse ratio. What changed is sentiment. What changed is technical structure. What changed is that paper traders got shaken out while physical buyers in the East are still paying $7 over the Western paper price. That divergence is the signal. The ones who verify independently see it clearly. Bottom line. In my previous video, timestamp 220 onwards, I said we could go lower on paper because the 150 exponential moving average was acting as resistance. Go watch it yourself. Verify the timestamp. Check the price level when I said it. $3.6 trillion wiped in 90 minutes right before CPI and the Chinese New Year closure. Silver is at 75. If 74 holds, an inverse head and shoulders reversal pattern is possible. If it breaks, we could retest 64. The Shanghai premium is $7 and widening while paper crashes. Physical is separating. Banks are attacking right on schedule using SLV arbitrage and sophisticated algorithmic spoofing. The volatility is not going away. A March squeeze is possible according to James Turk's warning. CPI drops tomorrow. Watch the reaction. It tells you whether this was front-running or genuine risk-off positioning. Verify the video yourself. Check the SLV premium and discount data on public sources. Look at the Shanghai premium. It's $7 right now. Pull the COMEX registered inventory numbers and the March open interest data. It's all publicly available. Don't trust my analysis. Trust that the levels I identified played out exactly as described, and you can verify that with timestamps and price data. The people who do that homework understand this isn't prediction. This is reading the tape. This is understanding market structure. This is recognizing patterns that repeat because the playbook doesn't fundamentally change. Now let me show you the pattern that actually matters. The pattern that has destroyed every empire in recorded history. 3 times this has happened. 3 times it has ended the same way. The Roman Empire debased their currency. They reduced the silver content in the denarius from 100% to 5% over 2 centuries. Soldiers were paid in worthless coins. Farmers stopped selling food for currency. The empire collapsed from within before the barbarians ever arrived. Verified. The Dutch Empire fought endless wars and accumulated unsustainable debt. They lost their reserve currency status to the British pound. Their empire dissolved within a generation. Verified. The British Empire lost reserve currency status to the United States dollar after World War II. Within 30 years, they had dismantled their entire global empire. Verified. Same pattern. Same sequence. Same outcome. Now apply that pattern to today. The United States has $36 trillion in official debt. Unfunded liabilities exceed $200 trillion when you include Social Security and Medicare obligations. The dollar has lost over 98% of its purchasing power since the Federal Reserve was created in 1913. In 2023, the BRICS nations announced a gold-backed trade settlement system designed explicitly to bypass the dollar. In 2024, central banks purchased over 1,000 tons of gold, the highest annual total in decades. In 2025, Texas began minting state-backed gold and silver coins for retirement accounts. The smart money is leaving. Not might be leaving. Not thinking about leaving. Is leaving. Right now. You can verify every single fact I just stated with publicly available data from the Federal Reserve, the World Gold Council, and state legislative records. We are not approaching the edge anymore. We've already stepped off it, and the only question now is how long before we hit the ground. When that happens, the impact will be real and unavoidable. ATMs stop giving cash. Prices for food, fuel, and medicine surge. Your savings, your retirement, and your bank balance lose value faster than you can react. This isn't theory or exaggeration. It's history repeating itself. When reserve currencies fail, purchasing power collapses, and every empire that ignored the warning signs paid the price. The same pattern is unfolding again. But here's what most people never hear. Currency collapses don't destroy wealth, they transfer it. Money doesn't disappear, it moves. It shifts from weak paper assets into hard assets that survive monetary resets, like gold, silver, land, and productive businesses. The people who understand this aren't waiting for headlines or official announcements. They're acting now, while physical assets are still available, and while the gap between paper prices and real-world value is sending clear warning signals. This is the moment where systems break and fortunes are reshaped at the same time. The question is simple. Which side are you on? Paper promises in a weakening currency, or assets that have protected wealth for thousands of years? Read the pattern, think clearly, and invest with logic, not hype.